All right. Okay. So today we will talk about mortgage calculations and decisions in general. We will cover some concepts like loan constants, loan points, should people pay for loan points, lender's yield or effective borrower's yield, and then some APR and ARM related calculations. Okay. So the first concept I want to talk about is the loan constant. Loan constant is a very simple concept. It's a monthly loan constant, and it literally means that if you have $1 of loan, how much will you have to pay per month? So, for example, if the loan constant is 0.006, that means for every dollar that you have borrowed, you will owe 0.006 per month. Okay? So, what loan constant essentially tells you is what your monthly payment would be. It literally is basically loan principal multiplied by the monthly loan constant. That's what tells you what your monthly loan payment is. Okay. So suppose that your loan amount was 500,000 and monthly loan constant on this loan was 0.0053. That means your monthly payment will be 500,000 multiplied by the 0.0053, which is 2650. Cool. The loan constant, we are not going to get into the derivation of it, but essentially it's derived using a standard mortgage payment formula, a typical NPV mortgage payment calculation that we have seen before. And it's basically affected by two things, the interest rate and the term or the time period of the loan. If the interest rate is higher, loan constant is usually higher. If the term of the loan is longer, the loan constant is usually lower. Okay. So now let's talk about something a bit more interesting, loan points. So, whenever people go to buy a house, they always face this dilemma of whether to pay for loan points to reduce their rate or not. So, what do loan points mean? Loan points are essentially discount points where you pay a upfront one time fee to the bank and the bank lowers your rate. Okay. So, basically, suppose that the bank was offering you 4% interest rate and you don't like that interest rate, you want a lower interest rate. What you do is you pay the bank some upfront fee and tell the bank to lower your interest rate from 4% to say 3.75%. And maybe the bank will charge you some fee for that. Basically, it's idea of prepaid interest in general, right? That fee could be considered as a prepaid interest, essentially. So whether this is a good financial decision or not, it really depends in general. Usually, that decision of whether buying points to reduce rate is a good decision or not, it depends on how long the borrower is going to anticipate that they will stay in that home. If they stay in the home longer, that means the points become more attractive, as in you take advantage of that lowered interest rate for a longer time. If you are going to sell the house in, say, 5, 7 years, then buying points doesn't really make sense because you only get to enjoy that lower interest rate for, say, 5 to 7 years. Think about it this way. You paid some upfront fee to a bank, let's say $10,000, to reduce your interest rate by 0.25%. Okay. When you do this, you're reducing that interest payment for, say, 30 years of the loan term, right? That means if you sell the house in, say, 7 years, that 23 extra years of lower interest rate that you paid for is gone. As in, you didn't take advantage of your points. Okay, so that's why the longer you plan to stay and hold the house, usually if you hold the house forever during the entire term of the loan, then points become attractive. In general, one discount point means the mortgage rate goes down by 25 basis points. So usually you pay 1% of the loan balance. So suppose that you have a loan of $500,000, you will pay 1% of $500,000, so $5,000 to reduce interest rate by 0.25%. Okay? Or 25 basis points. Because remember, 1 bips equals 0.01%. I will repeat. In general, the offer that people get when they are going to a bank is that pay 1% of the loan balance to reduce the interest rate on your loan by 25 basis points or 25 bips. Okay. Now, let's talk about lender's yield. Lender's yield is simply the rate of return that a lender earns on a loan. So, if there are no fees, no closing costs, or nothing else like that, then lender's yield basically just means the interest rate. So, for example, if you borrow $100 at 5% interest rate, there are no fees, nothing else, the lender gets 5% interest rate, that's their yield. But we know real world doesn't work like that. In real world mortgages, we have loan fees, closing costs, discount points, and all sorts of stuff, right? We have origination fee, application fee, processing fee, underwriting fee, and all this stuff. So, generally speaking, all these fees make the lender's yield calculation slightly complicated. How so? Let's look at an example. Suppose that you're taking out a $100,000 loan. The bank charges $3,000 in fees. Now, these fees are essentially kept by the bank, right? So what that means is that they only paid you $97,000 in loans, but the monthly payments you are making are for a loan of $100,000. Bank only lent you 97,000, but you are making payments on $100,000. So because that lender invested less cash, but they are getting the same interest rate, that means their lender's yield will be higher than compared to this simpler case. Okay, because that $3,000 extra cash they got up front. Okay, so generally speaking, if there are fees or any other things, lender's yield is usually higher than the interest rate. Basically means that the bank makes more money than what interest rate they are supposedly charging. Okay. Now let's look at the other side of this equation, which is the effective borrowing cost. This is basically how much it costs the borrower to borrow or take a loan. So very similar to lender's yield, but it's from the borrower's perspective. This includes one very key difference. Any fees that are paid to even third parties, not just the lender's closing cost. Suppose that you used a mortgage broker or the title insurance that you had to buy. All these things are also included in effective borrower's cost because the borrower gets charged that money, right? Even though it's not going to the lender, it's going to the title insurance company or mortgage insurance or appraisal, whatever it is, the borrower has to pay. So that's why it's included in their cost. Okay. Generally speaking, the effective borrowing cost will always be higher than the lender's yield. This is because all these other things start showing up, right, in the borrowing costs that are not going to the lender. So usually the effective borrowing cost is always higher than the lender's yield, or at least equal to the lender's yield, if nothing else. Basically, what it says is that it costs the borrowers more money to borrow or more percentage cost to borrow than what bankers are yielding because of the third party fees. Okay, simple enough. Now, let's talk about a similar concept which is extremely popular in mortgages discussion is APR or annual percentage rate. APR or annual percentage rate is a special case of the effective borrowing cost. And Truth in Lending Act actually requires the lenders to inform the borrowers what the APR on a loan is. Okay. It's supposed to get at the actual true cost of borrowing for the borrowers. APR calculations include all the financial charges that are in connection to the loan. If you bought points, those are included. If the banks charged origination fees, that's included. Your mortgage insurance that you had to buy, if you are making PMI payments or upfront payments, that's included. If you used a mortgage broker, that fee or compensation paid to that mortgage broker is also included. Any other charges that lender charges the borrower are also included. If you are making insurance premium payments, those are also included. And essentially, again, what APR tries to get at is what's the true cost of borrowing. Sure, the bank says the interest rate is 5%, but after adding all these fees, the effective interest rate might be 6%. That's what APR tries to get at. Okay. One key thing about APR is it assumes zero repayment whatsoever. So we know that, zero prepayment whatsoever. We know that most people don't hold their house throughout the entire life of the loan. People end up moving because of jobs. People have kids, they need bigger houses, things like that happen, right? So usually there is prepayment in real world, but APR does not assume any prepayment. So how does the prepayment impact this lender sealed and borrower's effective borrowing cost? So usually people start paying off loans early, like I mentioned. Most housing mortgages are prepaid early. Either when if the rates dropped, people try to refinance their mortgages at lower rates, like we have discussed, or people move to a new location and they have to sell a home. Maybe they got a new job in a different city, or maybe they need a bigger house because they had kids, etc. Or people sometimes just have extra money. Maybe they got a raise or a bonus that they put towards their house payment to pay down the loan extra. Okay. So this prepayment significantly impacts the yields that we have discussed about so far. And even more so when there are more upfront fees. Think about it this way. If you are buying points, which are the upfront fees, right? If you are paying 1% of the loan balance, let's say your loan, excuse me, okay, let's say your loan balance is 500K. You paid 1% of that balance, which is going to be 5K, to reduce interest rate from 5% to 4.775%, right? That's the scenario. Now remember that you paid 5K, and actually let's assume the life of the loan is 30 years. You paid 5K to reduce this interest rate from 5 to 4.75%, to reduce interest rate by 0.25% or 25 bips for 30 years. That's the important part there, right? Now, if you move in 5 years, then maybe you should have only paid less amount to only reduce the interest rate by for 5 years, not 30 years. What I'm trying to say is you paid a fee to lower interest rate for 30 years, but then you didn't take advantage of that because you moved in 5 years. You only took advantage of that for 5 years, not 30 years, right? So that's the difference. So if in general there are more upfront fees, the loan is paid off earlier, and the loan is paid off earlier, the lender sealed and effective borrowing cost end up being higher. As in, borrowers pay money upfront that was supposed to be distributed over 30 years, but now it's concentrated in only 5 years because they sold the house in 5 years. Okay, I will repeat. In general, if there are more upfront fees and the loan is paid off earlier, the lender's yield and effective borrowing cost both are higher. Not the APR, because APR doesn't care about any prepayment, right? So that's the difference between APR, the lender's yield, and effective borrowing cost. All right. Let's look at an example about points. So this example here shows you effective borrowing cost, points, and holding period. So this is a 30-year, $200,000 fixed payment mortgage. The interest rate is 6% and upfront financing costs are 3,000. Okay. And what we are seeing here, these different rates are if the borrower had bought 0 discount points and paid off the loan in 2 years, as in they sold the house off in 2 years, let's say, their effective borrowing cost would have been 6.81%. If the borrower had bought 0.5 points, as in reducing their interest rate by 0.5%, and they sold the house off in 2 years, their effective borrowing cost will be higher at 7.9%, 09%. Similarly, if the borrower had bought 1 point, the 1 discount point, 1%, and let's say they sold the house off in 10 years, their effective borrowing cost will be 6.36%. Okay. That's what this table is showing. Now, the initial interest rate is 6%, and the table assumes that even though the borrower is buying points, all these calculations are done using 6% interest rate to keep things simple. So, but even if you include that reduction in 6% interest rate, the conclusion that we are going to see from this table doesn't change. Okay. So let's see what's happening here. The more discount points you buy, there are more upfront fees, right? And if you close the loan off early, your effective borrowing cost increases. So if you bought 0 discount points and closed the loan off early, your effective borrowing cost will be 6.81%. If you bought 2.5 points and closed the loan off early in 2 years, your effective borrowing cost would be 8.2%, which is almost 1.5-ish% higher, right? If you keep holding the loan slightly longer, say you closed off the loan or prepaid it in 10 years, and your discount points were 0, so you didn't buy any discount points and you prepaid the loan in 10 years, your effective borrowing cost would have been 6.22%. Instead, if you had bought 2.5 points and closed the loan off in 10 years, effective borrowing cost would have been 6.58%. So the difference between this 6.22 and 6.58 is much lower. As in, the longer you hold the loan, this impact of points paid upfront on the effective borrowing cost is not that drastic. I will repeat. As more points are paid upfront, the effective borrowing cost rises sharply for shorter time periods. If you hold the loan off for 30 years, the effective borrowing cost doesn't really change that much from if you bought 0 points versus 6.39, 0 points versus 2.5 points. Okay. So the rate of increase in 2 years is higher than 4 years, than 6 years, than 8 years, than 10 years. And at 30 years, it's basically almost flat. Okay. So should we buy points when we are getting mortgages? Well, it depends. What does it depend on? How long you're going to be in that house and how long are you going to have that loan? If you are prepaying the loan or not, that's the decision that you have to make in terms of whether you should buy points or not. So, longer the time you're in the loan, longer the time you can enjoy the lower interest rate that you bought by paying these points. I'll repeat, longer the time you are in the loan, longer time you have to enjoy this lower interest rate you bought by paying points upfront. Shorter the case, well, we just saw if you're in the loan for shorter amount of time, the effective borrowing cost increases with points. So it doesn't make sense to buy points if you're going to be in the loan for short duration of the time. Now, people don't really know for certain, right? If they get a really amazing opportunity in a new job and they have to move to a different city and sell their house. So because we don't know how long we'll be in the house for certain, we can only project the effective borrowing cost based on how long we believe we'll be in that home. And if you're not sure of that, usually a safe bet is that don't buy points. I will go one step further and I will say that if you are sure that you're not going to be in the house for the entire term of the loan, so in this case, this was a 30-year term. If you're sure that you're not going to be in the house for the entire term of the loan, then buying points is usually a bad idea. Okay. Now, let's talk about ARMs or adjustable rate mortgages. So, as we have discussed before, ARMs have a pre-specified number of years where the interest rate remains fixed, and then after that, it starts changing periodically following some specified index, like it used to be LIBOR back in the day, and now it's different. Okay. Usually, you will notice that ARMs have lower interest rates than fixed rate mortgages because the borrower is taking the interest rate risk, right? After the fixed period ends, if the interest rates in the economy go up, the borrower's interest rate goes up. For fixed rate mortgages, that risk is held by the banks. For ARMs, that risk is held by the borrowers. That's why, to compensate the borrower for this interest rate risk that they hold, the bank usually gives you a lower interest rate on ARMs. Okay. So usually these ARM mortgages start off with a much lower interest rate. And how much lower? That depends on how long is the fixed term of the loan. So for example, consider a 3-1 ARM where basically you have 3 years of fixed interest rate, then every year the interest rate changes. And a 10-1 ARM where you have a 10 years of fixed term where fixed interest rate is constant, and then after that, every year the interest rate changes. In this scenario, the first number is telling you the initial fixed period, right? In this scenario, the borrower holds the risk or interest rate risk for the entire life of the loan minus 3 years in the first case. And in the second case, the borrower is holding the interest rate risk for the entire life of the loan minus 10 years. Why so? Well, suppose that the loan was 30-year long. In the first case, the borrower has fixed rate for 3 years and then 27 years of variable rate, right? So that's 27 years of interest rate changing risk. If the rates go up in those 27 years, the borrower has to pay more. That's the risk. Okay. In the second case, we have essentially 30 years of loan, 10 years are fixed rate, and then 20 years of variable rate, right? So borrower is only holding interest rate risk for 20 years. That's why the first arm will have a lower interest rate because the borrower has to take more risk, so they get lower interest rate. In the second case, the borrower has to take, sorry, in the first case, the borrower has to take more interest rate risk of 27 years, so they get lower rate. In the second case, the borrower has to take less interest rate risk, so they get higher rate compared to the first one. Okay, and that's how ARM calculations essentially work. All right, so now let's talk about rate caps on ARMs. As we have discussed before, rate caps essentially limit how much the interest rates can change on an adjustable rate mortgage. A very common cap structure is 225 on an ARM. What that means is that after the first fixed period, when the first adjustment is coming, the interest rate can only change maximum by 2%. After that, every subsequent period, again, the interest rate can maximum change by 2%. And in the total lifetime of the loan, the interest rate can change by maximum of 5%. Okay. So essentially, these caps are there to protect the borrowers from extreme rate increases. For example, suppose that you have a 5-year ARM, as in the first 5 years you get fixed interest rate, and that fixed interest rate is 3%. And in the 6th year, now markets have jumped by 6% in terms of interest rates. So basically, you had a 5-year ARM at 3% interest rate in the first 5 years, and in the 6th years, the interest rates in the market jumped by 6%. Initial 2-to-5 structure here essentially means that after the first 5 years in the 6th year, your rate can only increase by 2% maximum, right? Even though markets jump by 6%, your rate will only increase by 2%. So basically, in this case, your final rate will be the initial 3% plus this 2% increase. Okay. In this entire example, suppose that the markets jumped again by 6% next in year 7. So in year 7, rates went up by 6% in the market. So market rates went up by 6% more. What will be our new interest rate? Well, subsequent rate increases are capped by 2%. So this means that our rate can be maximum will be 5%, which was 6th-year interest rate, plus 2% of the adjustment in the 7-year. So that will be 7%. Okay. Now let's assume that in year, let me adjust this so you guys can see. So assume that in year 8, market rates went up by 4% again. Okay. What will be my interest rate in this case? Well, again, if my rates are going by 4%, maximum I can increase the rate by 2%, right? My rate was already 5% from 7th year plus 2% will give me, sorry, my interest rate from last 6th year or 7th year was 7%. So that was my previous interest rate. Now in year 8, market rates went up by 4%. Maximum increase on an annual basis I can have each period is 2%. So my rates will be, final rate will be 9%. But hold on a second. That means that I started off at 3% and now my rate is 9%. That doesn't make sense because my rate can only increase over the term of the loan by 5% over the lifetime, right? So another cap will hit here and this will come down to 8% instead, not 9%, because the max cap of 5% just hit. Let's go through this example one more time. If you have a 5-year ARM, that means fixed period on this ARM is 5 years at 3%. Okay, that's your interest rate for the first 5 years. Now in the 6th years, market rates have jumped by 6%. That means in year 6, your rates are going to go up, but by how much? Well, maximum they can go up by is 2%. So this means that in year 6, the maximum rate that you will pay is the initial 3% plus this 2% of initial cap, which means total of 5%. Now in the year 7, market rates went up by 6 more percent. We are in an insane, crazy economy, I guess, in this example. Now your rate in the last year was 5%. Market rates went up, so your interest rate is going to go up because this is an ARM. By how much will they go up? Well, subsequent period cap is 2%. So your rate was 5%, cap is 2%. Well, your rate will be 7%. Now in year 8, market rates went up again by 4%. That's insane. So if the market rates went up, your interest rate that was 7%, that's also going to go up. So how much will it go up? Well, subsequent period adjustment is still 2%, right? Your rate was 7%, it will go up by 2% to 9%, right? But hold on a second, that doesn't make any sense because I started off at 3% and now they're saying my interest rate will be 9%. That's 6% higher than my initial interest rate, right? But that doesn't make sense because my interest rate can be only 5% higher than the initial interest rate because I have this 5% lifetime cap over the initial rate. So that 9% gets down to 8% because the 5% cap hits. Okay, that's how rate caps on ARMs work. So that will close out our mortgage calculations topic. But before you go, and before we move on to something else, I do want to give a closing comment on this. Imagine there is an individual out there, or you are an individual with zero real estate education, okay, which is most majority of the people out there, if not most. Now, they're buying a house and they go to a bank to get a loan. And what they're offered by a mortgage broker or a bank is a 3-1 arm with a 2-year teaser rate at 3% based on LIBOR index, a 3% margin, a 5% periodic rate cap, and a 10% lifetime rate cap. Now, we have gone through all of this stuff, right? Furthermore, they are offered to buy down this rate by paying off points. So the bank or the broker tells them that you can lower the rate by buying on 25 basis points using discount points, but you will have to pay $5,000 in upfront fees. Can we reasonably expect this individual to actually calculate their effective borrowing cost and advocate for themselves in making a good financial decision? No. Normal people out there don't know what the hell this stuff means, let alone the impact of points and how long they're going to stay in the house. Now, add to this thing a loan officer or a broker who essentially makes commissions if they originate more complex loans. So, simple loans, they might make 1% commission. On complex loans, they might make 1.5% commissions. Obviously, they're going to try to push these more complex loans. When you put all this together with zero real estate education, what you get is a financial crisis that happened in 2008 times, essentially. Okay. All right. We will stop there and I will see you guys next time.